during a weak dollar regime, emerging markets tend to perform better. Big emerging markets like China and India.
Mm-hmm.
Now, why would that be?
Are there certain warning signs that you would be paying attention to that would say the Fed is on the road to losing a lot of its independence? What would you be watching? Welcome to the HKUST MBA Superconnector podcast. This episode's guest is Professor Paul Kitney. Paul teaches macroeconomics in our MBA program. He brings over 30 years of research-based and practitioner experience to the classroom. He has been an investment strategist at Morgan Stanley, Daiwa Securities, and BlackRock. Paul's PhD in economics is from the Australia National University. If Paul's voice sounds familiar, you may have heard him as a guest speaker interviewed on Bloomberg, CNBC, or other financial media. I've divided today's podcast into two sections. In the first, I ask Paul to shed light on the current questions about the independence of the U.S. Federal Reserve. Specifically, what happens if it loses its independence? I'll note that this was recorded on September 11th, 2025. In the second section, we get to know Paul at a more personal level. Paul and I discuss how and why he made his transition from investing in Hong Kong Central to teaching future leaders the ins and outs of macroeconomics in Clearwater Bay. We also explore how Paul's lessons from investing inform his personal interest of trekking and mountain climbing, as well as his current thinking on peak performance. If you are interested in more like this, please follow us on Spotify, Apple Podcasts, or YouTube. Paul, great to see you. Thanks for joining our podcast. I want to use this time to get your thoughts on some of what's happening today in the markets, and also to hear a little bit more about your teaching, your story, teaching here at the HKUST MBA program. But let's start with today. There's a lot of news around the Fed. Everyone's watching the Fed. And one of the questions is, how independent is the Fed? Will it stay independent? And I'm not asking you to predict the future, but if the Fed were to be perceived as being less independent, what would that mean for us? What would the implications be?
Great, Steve. Well, thank you for inviting me to this podcast. You've hit on a very topical, interesting, and important area, I think, for all of us, whether you are an investor or whether you are a private citizen in the US or anywhere around the world. The independence of the Fed is an extremely important thing. So let's look at the Fed. The Fed was set up as an independent organization to conduct monetary policy and to also supervise the banking system. Okay, so they have micro-prudential and macro-prudential responsibilities for the financial system, overseeing the behavior of banks and regulation of the banking system, as well as the conduct of monetary policy. So monetary policy is designed to control the money supply in the US in order to achieve two co-equal objectives. This is the Fed's dual mandate. And that dual mandate is inflation stabilization around the inflation target, which is 2%, and full employment. So these are, one objective is not more important than the other. They're both two co-equal objectives. And they take this very, very seriously. So if you read the FOMC, that's the Monetary Policy Committee of the Fed, the Fed's Open Market Committee, meeting minutes and documentation, they refer regularly to this dual mandate. So they take it very, very seriously. Now, inflation stabilization is incredibly important when it comes to the predictability of pricing and decision makers that executives will make as CEOs, COOs of organizations, knowing that supply chain prices are relatively predictable. They don't have to be low. It doesn't matter necessarily if they're high, but they need to be predictable. The more predictable prices are, the better decision-making can be done. And studies have shown that the less volatility there is in inflation, irrespective of the level, it leads to better economic outcomes. Okay, so that predictability is very, very important. So agents in the economy, whether it be firms, private agents, firms, or whether it be households making their decisions, right, will have done hitherto looked at the Fed's dual mandate as a way in which they set monetary policy. Now, if there was a question mark regarding the independence of the Fed, most studies will show that this will lead to what's called a time inconsistency problem. So what do we mean by that? So time inconsistency problem, something I teach my global macro students in the MBA program. The time inconsistency problem is when you have a long-term objective, such as price stability, but then you interfere with that with short-term objectives, which might be macro stabilization in the business cycle in the short run. So for example, if you've got an election coming up, right, stimulate the economy ahead of the election might get you some more votes. But if you do that, then you may jeopardize the long-term objective of price stability, which is this time inconsistency problem.
Yep.
So there's a lot of academic work as well as industry work on this particular problem. Now, when you have interference at a central bank, palpable interference at central banks, a record of it in recent times is in Turkey, is in Russia, Argentina, and in all cases, there has been a significant positive inflation bias. It leads to higher inflation. When you've had a reduction in independence of central bank decision-making, whether it's through political influence or more subtle influence, it leads to a positive inflation bias. So inflation will creep up, and it may creep up by a lot. Okay. Now, in the case of Turkey, and some of the South American countries, and indeed Russia, it led to a large increase in triple-digit basis point increase in inflation. This led to a weakening in the currency in all of those countries. Okay. And what it also led to was an increase in the sovereign risk premium of those countries. That means in order to fund budget deficits, it costs those countries a lot more. So what is a sovereign risk premium or sovereign credit spread? It's basically what 10-year bond yields are relative to the global average. And if it increases because of a perception that there is not a credible monetary policy, then that risk premium can rise, and it typically is associated with higher inflation and weaker exchange rate.
One of the debates, I guess, is also what interest rate. Should the Fed bring down interest rates? But it sounds like what you're saying is if that happens and if inflation goes up, you could end up in a world where you've got both higher borrowing costs as well as higher inflation.
Right. So interest rates and inflation have a very close connection through what's known as the Fisher effect. So the Fisher effect says that nominal interest rates are proportional to inflation expectations. So if inflation expectations rise, nominal interest rates rise. When we talk about nominal interest rates, we're talking about market interest rates, not the policy rate. The Fed's policy rate is the federal funds rate. It's a very, very short-term rate, almost overnight. Okay. What I'm talking about is that you could have the Fed lowering short-term rates via the federal funds rate, but then the market anticipating higher inflation, pushing up yields in the 10 to 30-year range, deepening the yield curve and leading to higher borrowing costs for the for the Treasury in the United States to fund their deficit, but it also will have private market implications because mortgage rates are priced off the long end of the yield curve. And that will make it more expensive to refinance debt if you are a homeowner.
So if the Fed is perceived to be less independent, what's going to happen? Or what will, is this just a really bad thing for the global economy? Are there any bright spots? Are there any beneficiaries?
This is, I think what we've already seen has been, if you look at the dollar index, right? So it's a weighted average of the DXY index, if you go onto your Bloomberg screen, is a weighted average of a trade-weighted average of the US dollar versus its main trading partners. It has been declining gradually, incrementally, for the past year and year and a half. And this has been, in my opinion, as a result of the rhetoric that we've seen regarding the criticism of the Fed, the threats to replace the current Fed chairman with a new person. To be fair, the candidates that have been put up are all central bankers. The majority are central bankers who understand credibility of monetary policy, the time inconsistency problem, and the issue regarding inflation bias. I'm personally not too concerned, but nevertheless, if we're looking at the hypothetical, if we're thinking about the hypothetical, the Fed does lose independence, then it will lead to higher global, because the US is such a large portion of the global economy. It will have, and it's a large open economy, it will impact global interest rates and global borrowing costs. So net, it will be negative for economic activity. It'll be negative for the US dollar. This is a good reason, one of the key reasons why gold and other precious metals have performed so well over the past year and a half. Gold is considered a alternative to fiat currency. It was the previous reserve currency, right? Where we had a gold standard. Yeah. Central banks around the world, not exclusively, but in a high profile way, the PBOC, the People's Bank of China, has been buying lots of gold, particularly over the past year or two. Okay. Gold purchases by central banks has been, I believe, a sort of a function of a number of factors. One is a gradual reduction in the importance of the US dollar as a reserve currency. I'm not saying that there's an immediate alternative, but reserve currency it's not an all or nothing thing. Foreign reserves, the percentage of foreign reserves held in the US dollar has been gradually declining over time and has sped up in the past year or so through gold purchases. So it's a diversification, if you like, hedge, if you like, against the potential for an increase in the US risk premium that may come about, for example, from the Fed losing some of its independence. Where could the bright spots be? Those countries that benefit from a weaker US dollar, typically emerging markets. So I did a study when I was in industry that looked at the performance in equity markets, for example, of emerging markets during different dollar regimes. So during a rising dollar regimes, developed markets tend to outperform emerging markets. During a weak dollar regime, emerging markets tend to perform better. Big emerging markets like China and India. Now, why would that be? What's the, I mean, that's a statistical relationship. Is there any intuition or any economic? There really is. And the reason is that many emerging markets have got dollar-denominated debt, right? Whether it be corporate debt or sovereign or to some degree, government debt. Now, when the local currency is strong, i.e., a weaker US dollar, their ability in local currency terms to be able to fund that debt is much better. It's much easier during that time. There's a windfall. And that's positive for emerging markets during a weak dollar regime. Conversely, when the US dollar is very strong, in local currency terms, the debt servicing burden becomes much more challenging. And that puts pressure on those economies and those markets during those times. Having said that, so this is a relative thing. So relatively, this perhaps is good for emerging markets overall, but an increase in the global interest rates, with the US having an increase in interest rates, is a lose-lose for everybody.
This is really helpful to get behind the headlines and get into more of what's really could really happen. It sounds like you're not too pessimistic on the Fed losing its independence. Are there certain warning signs that you would be paying attention to that would say the Fed is on the road to losing a lot of its independence? What would you be watching?
Well, I think the first thing is going to be, first of all, the current chairman of the Fed is going to move on. And I think first of all will be the choice of his successor. So Jerome Powell. Now, there are a number of really high quality people on the shortlist, including Chris Waller from the St. Louis Fed, who used to be the deputy to Jim Bullard, which was a high profile figure that I knew reasonably well. And he's a very solid professional. Some of the other candidates are also solid professionals. So I think, first of all, we need to see who the successor will be. Now, then thereafter, in terms of behavior, I think it's going to be critical to see how the Fed sets its monetary policy, in particular its policy interest rate, right, in relation to the data. If inflation remains sticky, and it is, CPI inflation in the United States right now is 2.8%. It's still well above the inflation target of 2%. It hasn't come down. Now, the labor market is weak, right? The non-farm payroll numbers have been so weak that the executive branch of the US has decided to remove the head of the Bureau of Labor Statistics because they didn't like the numbers coming out. Very weak numbers that are coming out in the labor market. That will translate into higher unemployment. Remember the two dual mandates, co-equal objective of inflation stabilization around the 2% target and full employment. If these numbers continue to be weak, unemployment will rise. Now, if unemployment rise, that gives a legitimate, credible signal for the Fed to cut rates. Having said that, to be very confident about that decision and to be consistent with that dual mandate, you would need to see inflation drop. So if inflation drops and unemployment rises and they cut rates, that's not evidence of a lack of independence. However, if inflation remains stubbornly high, the labor market stabilizes, a new Fed chairman comes in and they cut rates and aggressively straight away, that's a red flag.
Okay, so you'd watch their behaviors and
absolutely.
Yeah.
And in particular, the Fed's policy reaction function. So the Fed's policy reaction function is changing interest rates if either the inflation gap, which relates to the inflation stabilization around the inflation target, or the output gap, which relates to full employment, changes. And if they are behaving according to their policy reaction function, right, then everything is green light. However, if they start violating that, and in particular, if they violate the Taylor principle, right, the Taylor principle says that if inflation rises by 1%, to stabilize inflation, you need to increase the policy interest rate by more than 1%. Why? If you increase it by more than 1%, then real interest rates, which is the nominal interest rate minus inflation, goes up. And that puts downward pressure on prices. However, if that Taylor principle is not adhered to, which, to be fair, probably occurred in some period after the COVID shock, where inflation did rise to a 40-year high, then you can get, if you like, fulfilling fluctuations, where inflation expectations, increases in inflation expectations lead to higher realized inflation. And in order to anchor inflation down, you need to have a discipline, the discipline of the policy reaction function and the Taylor principle.
If you are interested in hearing more about Paul's insights on macroeconomics and the world today, please stay tuned for an upcoming masterclass by Paul. We will be hosting this virtually in December. Follow HKUST MBA on LinkedIn, Instagram, WeChat, or RedNote to be the first to hear about how to register for Paul's masterclass. And if you're interested in learning more about Paul and his transition into teaching, please do listen to part B of this podcast interview.